Once the darling of Wall Street and a symbol of innovation, Tesla is now facing a dramatic downturn. In just a few months, its stock has plunged by 45%, sending shockwaves through investors and the broader market. The electric vehicle giant is struggling with declining sales in China and Europe, where shifting economic policies and weakening demand are taking a toll. Meanwhile, President Trump's newly imposed tariffs on imports from Mexico, China, and other key trade partners are exacerbating Tesla's troubles, threatening supply chains and profitability. Even at home, things don't look good. In fact, Trump and Tesla have lost $127 billion in one day after the EU and Canada retaliated to Trump's tariffs. So, is this just a temporary slump, or a sign of deeper structural problems that could reshape Tesla's future? Hang tight as we answer this and much more. Tesla's decline following tariffs. Business Insider reports that Tesla has experienced a significant decline in its market capitalization over recent months. At its peak in December 2024, Tesla's market value was approximately $1.54 trillion. By March 2025, this valuation had fallen to about $777 billion, indicating a loss of nearly $763 billion. This steep decline reflects a combination of factors, including global sales challenges and branding issues associated with its CEO's political activities. In a particularly sharp downturn, Tesla's shares dropped over 15% on a single day in March 2025, erasing about $127 billion from its market capitalization. Overall, since December 2024, Tesla's market value has decreased by a whopping 49%. This sharp downturn has sent shockwaves through Wall Street, with investors scrambling to reassess Tesla's valuation amid growing economic and geopolitical uncertainties. The drop represents one of the most significant losses in Tesla's history, rivaling the turmoil experienced during the early days of the COVID-19 pandemic. So, what's next for the brand? Is this a temporary setback, or does this mark the end for Tesla? To understand that, let's understand the whole story. Major institutional investors, who once championed Tesla as a revolutionary force in the automotive industry, have begun reducing their exposure, fearing prolonged instability. Hedge funds, which previously viewed Tesla as a high-growth stock, are now shorting it aggressively, anticipating further losses as market conditions worsen. Retail investors, many of whom had built their portfolios around Tesla's meteoric rise, are witnessing devastating losses, with some liquidating positions at a fraction of their original purchase prices. This erosion of confidence has made Tesla one of the most volatile stocks on the Nasdaq, increasing concerns about its ability to raise capital for future projects. Compounding the issue is the broader market downturn in the tech sector, where high interest rates and economic uncertainty have led to a sell-off in growth stocks, further amplifying Tesla's decline. A significant driver behind Tesla's collapse is the rapid deterioration of its position in China, historically one of its most crucial markets. Once considered Tesla's gateway to global EV dominance, China now represents one of its greatest vulnerabilities, with sales in the country plummeting by a staggering 50%. This decline is not merely a short-term fluctuation, but a symptom of deep-rooted challenges that threaten Tesla's long-term viability in the region. Chinese automakers, led by giants such as BYD, NIO, XPeng, and Li Auto, have aggressively expanded their market share, offering technologically advanced electric vehicles at significantly lower price points. BYD, in particular, has emerged as Tesla's most formidable competitor, recently surpassing Tesla in global EV sales, a milestone that would have been unthinkable just a few years ago. Tesla's once dominant position in China has been eroded by a combination of aggressive government-backed support for domestic automakers, a slowdown in the Chinese economy, and evolving consumer preferences that favor local brands. Unlike Tesla, which has struggled with production costs and pricing pressures, Chinese EV manufacturers benefit from robust state subsidies, streamlined supply chains, and government incentives that make their vehicles more attractive to buyers. The Chinese government has also implemented policies favoring domestic brands in areas such as government fleet purchases, EV infrastructure investments, and battery technology subsidies, further tilting the playing field against Tesla. Another major blow to Tesla's prospects in China is the ongoing deterioration in US-China relations, which has fueled nationalist sentiment among Chinese consumers. Many buyers who previously saw Tesla as a status symbol now perceive it as a foreign brand that is misaligned with China's growing emphasis on technological self-sufficiency. This shift in perception has significantly impacted Tesla's sales, leading to growing inventories, reduced factory output, and increased discounting to clear unsold stock. Tesla has been forced to cut prices multiple times in China to stay competitive, but this strategy has backfired, leading to thinner profit margins and weakening the brand's premium appeal. Adding to the complexity is the Chinese government's push for self-reliance in battery technology, which could disrupt Tesla's supply chain, particularly its reliance on Chinese battery manufacturers. Beyond China, Tesla is grappling with severe challenges in Europe, where its sales have plummeted by 29% in a matter of months. While the European market was once a stronghold for Tesla, driven by early adoption of EVs and government incentives, the landscape has shifted dramatically. European automakers, including Volkswagen, BMW, Mercedes-Benz, and Renault, have aggressively ramped up their e-production, introducing models that directly compete with Tesla in performance, technology, and price. Unlike in previous years, where Tesla enjoyed a first-mover advantage, European consumers now have an abundance of choices, many of which come with brand loyalty, superior local service networks, and financing incentives. Tesla's struggle in Europe has been exacerbated by a combination of economic headwinds, regulatory challenges, and shifting consumer behavior. One of the biggest setbacks has been the reduction of government EV subsidies in key markets like Germany, the UK, and France. Many of these countries, facing fiscal pressures, have scaled back incentives for electric vehicles, making Tesla's already expensive lineup less attractive to cost-conscious buyers. Furthermore, production costs have surged due to inflation, supply chain disruptions, and the energy crisis triggered by geopolitical instability. These factors have significantly increased the price of Tesla vehicles, making them less competitive against both legacy automakers and emerging EV startups. Additionally, Tesla's reliance on imports for certain vehicle components has subjected it to high tariffs, further inflating prices and eroding its cost advantage. In contrast, European automakers benefit from local production facilities that shield them from these cost pressures, allowing them to offer better prices. Tesla's challenges in Europe have also been compounded by rising competition in the commercial and fleet vehicle segments. Companies looking to electrify their vehicle fleets are now opting for European-made EVs, which often come with government-backed incentives and favorable leasing terms. If Tesla fails to reverse this trend, it risks losing its foothold in one of the world's most mature and lucrative EV markets. Overall, the combination of a collapsing stock price, declining sales in key international markets, and growing competitive pressures has put Tesla's long-term growth story at risk. Elon Musk, who has long been the face of Tesla's success, now finds himself under mounting scrutiny from investors and analysts, many of whom question whether he can navigate the company through this crisis. Tesla's future will depend on its ability to regain momentum in China, strengthen its position in Europe, and counter the growing threat of emerging competitors. If the company fails to address these challenges, it could face an extended period of stagnation, forcing it to rethink its global strategy and potentially scale back its ambitious expansion plans. But wait, there's more to this story. Tesla is bearing the brunt of the current economic turmoil, with the company's reliance on global supply chains, shifting political alliances, and investor sentiment making it more vulnerable than other automakers. At the core of Tesla's troubles is the sharp rise in production costs, which have skyrocketed due to heavy reliance on imported components now subject to punishing tariffs. Unlike legacy automakers with well-established domestic supply chains, Tesla's business model is heavily dependent on international suppliers, particularly for critical materials like lithium, nickel, cobalt, and rare earth elements, essential for battery production. The tariffs imposed by the U.S. government on imports from China, Mexico, and other key trade partners have significantly increased the cost of these materials, making manufacturing far more expensive. Tesla's gigafactories, which were designed to drive down production costs through economies of scale, are now facing higher input costs that threaten their efficiency. The company's advanced manufacturing processes, which require high-precision machinery imported from Europe and Asia, have also been affected by tariffs. As a result, Tesla's vehicles have become more expensive to produce, forcing the company to either absorb the costs, cutting deeply into profit margins, or pass them on to consumers, making its EVs less competitive. Adding to the pressure is the sharp increase in battery production expenses. Tesla has long benefited from strong partnerships with Chinese battery manufacturers, but with escalating tariffs and geopolitical tensions, the cost of sourcing these essential components has surged. The company's attempts to localize battery production in the U.S. are still in their early stages and not yet capable of offsetting the immediate impact of these supply chain disruptions. The net effect of these compounding issues is a sharp erosion of Tesla's cost advantage, which previously allowed it to dominate the EV market. If production costs continue to rise at this rate, Tesla risks losing its ability to compete on price, especially against domestic competitors like Ford and GM, who have stronger local supply chains, as well as Chinese automakers that can produce EVs more cheaply. Tesla is also facing severe supply chain disruptions, exacerbated by trade barriers that have slowed the movement of essential components and vehicles. Tesla's production network spans multiple countries, with key facilities in the US, China, Germany, and Mexico, all of which are being affected by shifting trade policies. The company's factory in Mexico, which was expected to serve as a major production hub for North America, has been hit particularly hard by the tariffs imposed on Mexican imports. Originally designed to lower production costs by leveraging Mexico's cheaper labor and strategic location, Tesla's Mexican facility is now facing supply shortages and higher costs due to new trade restrictions.